Let's get us on stage. Okay, what's up? How's everybody doing today? We're gonna go over this. Look, we might get inflation break down to, come in to the downside. Inline inflation is bullish on Wednesday. Powell speaks tomorrow, and we're gonna go over the inflation numbers. So let's get started. Okay, so technically, right, S&P 500, we're looking at the whole equity market. We're pretty strong. We're almost at all-time highs. We're less than 1% from all-time highs. The market's been tremendously strong, putting in higher highs, higher lows. We're above anchored VWAP. We're getting bullish crosses here. So ever since that last Fed meeting, where the signal of the FOMC was, hey, QT is done, right? If you watch the shorts, I'm trying to tell you guys, liquidity is back. The Fed is quantitative easing in the next 12 months, right? We're headed towards more liquidity. That is what we're looking at. Let me know how the volume is. If it is off on YouTube, we will be showing all the charts on YouTube today. So the market is up. It's pretty strong. We're consolidating, right? Sideways, but the big rally might come this Wednesday, right? Wednesday or Thursday. I think we do pull back tomorrow. We'll see. This is strong. This is a pretty strong recovery. We do have NVIDIA earnings coming up, but let's take a look over at the inflation expectations, because a lot of expectations are that we are staring at stagflation. I don't think that is the case when I look at I don't think that's the case when we look at all the forward-looking data. But here's what we're looking at for tomorrow: PPI, month over month, and Powell speaks early. What is this going to be? 10 Eastern time. Now Powell probably already has the numbers. I guarantee you, Jerome Powell already has the CPI numbers. So pay attention to his tone, the way he talks about it. If he's confident, it's more likely. If he's a little more dovish, it's more likely the number is going to come in on Wednesday in line, which is bullish. Why? Because there's a lot of inflation numbers here, but let's look at the year over year. We're going to include energy. We're going to include food, right? The expectation for Wednesday, last month was a 3.5. The expectation is 3.4. That's consensus. That's why I think the S&P is bidding up, because the expectation is actually lower. Okay, so we're going to be pricing in disinflation going forward, right? It's just 1 month. But for the most part, a 3.4 is very bullish for the market. In the short term, I think we're at all-time highs, right? If we come in line, if CPI comes in line 3.4, we're looking at all-time highs for the S&P. We're probably getting a rally in utilities. We're getting a rally in technology again. I mean, we'll see who actually rallies here. I like Robinhood, I like Coinbase. I think crypto is going to do pretty well. There's a lot of stocks out there. It's a stock pickers market, but I'm taking, overall S&P 500. We're looking at all-time highs on Wednesday if we come in line. If there's a surprise, we are going to gap up tremendously if we get a 3.3, right? Now, what's going to get us to a 3.3? I'm not sure. We'll see. Okay, you still have core also. Core is expected to come in at 3.6. That's 2 points from that's 2/10 lower than the last print. This is very bullish. Okay, expectations, story here. Expectations are set to be very bullish on Wednesday. Listen to Powell and his tone, right? Where if you can, maybe you can't, we'll see. Go on Twitter, find out what he's saying. But his confidence level is really going to tell us what's going on. His tone tells us, hey, are we going to get those numbers, bullish, or dovish, or hawkish on Wednesday? He has another speech next week. So really, it's tomorrow and it's Wednesday. Those are the big macroeconomic data days going forward. Those are big days. So again, what might get what might get inflation lower? Let's take a look at why we could get that lower print. I'm gonna go back to the charts here though. Right now, here's a big clue. Oil's been pretty tame. Oil's not really, it's still tame, as in it's not moving higher. That's if oil stays sideways, it's a 0% inflation gain on energy. So oil's not doing anything. That's good. That's our sign. We got to look at oil. It's not moving. Great, right? Great. That's not going to push inflation up. That's going to keep inflation at 0% if it hasn't moved. Maybe a couple, maybe 0.1. We'll see. All right. Now looking at shelter again, TikTok, you guys ain't gonna be able to see this. Nvidia, well, we'll get to that. We're looking at why, market might hit all-time highs on Wednesday. Shelter is lagging, okay? Shelter continues to fall, not at the fast pace that we want it to, but it's still falling. Zillow, Redfin, all that data in real time is telling us, especially new tenant rents, that inflation is coming down. I rent, and my rent actually came down. So rent is coming down. Prices are not inflation. Let's get that clear. Prices are not inflation. Prices will never completely fall, but the inflation rate, the rate at which prices go up does fall, right? Now, this global supply chain pressure index, that's what we're taking a look at here. It is falling back down. So this is global supply chain pressures. The higher these pressures are, the higher prices go for producers. The more, that's it's harder to deliver. It's harder to move stuff across the ocean. Prices are higher, rates are higher, whatever. Well, those pressures are down. So into the second half of the year, we should see inflation fall, right? The rate at which prices go up, we should see that fall. Um, if we do look at the case freight index, which is part of the supply chain, I'm always looking at supply chain stuff. This is our forward looking data. Okay, going up. Supply chain, I'm sorry, packaged foods, automotive, chemicals, all these things are being pushed through the supply chain. So we're not having a shortage. There is no more shortages, right? 10-year rates. If we go to the the interest rate picture, rates are falling also. If interest rates start to break this trend and roll over, let's get back to interest rates. Sorry. If we do roll over here tomorrow, we do have PPI. We'll see how interest rates react. But I think Wednesday is going to really give us our direction. Wednesday, this cracks. Hey, if we come out at 3.5 negative, very bad. Stagflation, sticky inflation. But I doubt it because growth is, employment's a little weak. Employment is softening. Growth is starting to cool. That's what the market wants to see. It wants to see growth cool down, consumers chill out a little bit, and they are. They're not spending as much as they were. Maybe summer picks up. Obviously, it's summer travel time. But for the most part, I think we're going to see rates start to roll over. And that's one of the biggest impacts on the market at the moment. Oil is tame. The US dollar is looking like it wants to roll back over. This is a tailwind. Again, we've been talking about this. It's slowly grinding lower. The dollar is slowly becoming a tailwind for markets, right? So we're getting that bid higher. We'll look at NASDAQ. We'll look at NASDAQ in a second. So that's what we're looking at here. Now, also we have a lot of stocks. I think like what was it, GME today, GameStop, AMC. These are, I think this is just big risk on because the market is starting to sniff out that rates are coming lower. I think a lot of these risk assets are starting to price in interest rates coming lower because we're heading into if inflation hits 3.4 in line on Wednesday, I don't think people realize how bullish that is. That means we're back into Goldilocks. We're back into disinflation, right? It doesn't mean you're in disinflation. It just means the market's going to be expecting disinflation. So now you have GameStop, big move in GameStop, right, to the upside. Okay, we'll look at that data a little later. 1 second. Okay. So yeah, you got GameStop moving up, and then I think it was AMC. That was a big move too. AMC. No, it's not AM. Is it AMC? No, that's AMD. AMC. AMC also. So a lot of these these meme trades are starting to come back. You're seeing memes come back. Why? Because the anticipation that inflation comes in line, if you do hit expectations, rates should fall, and that's going to fuel markets higher. Okay, that would fuel markets higher. Also, utilities, right? XLU, if you want to look at utilities, these have been in a very strong uptrend. Utility sector is moving up, and it's just electricity costs, right? Because there's so much capex coming from big tech, Google, Amazon. They're all paying for data centers. Data center growth is set to accelerate tremendously. As that accelerates, you're going to get more electricity costs. As electricity costs go up, utilities, earnings, and profits also accelerate at the same time. So we're getting that into the market. This is my favorite. This is definitely not my favorite play. But if we get those rates roll over, which I'm anticipating at this point on Wednesday, because CPI set to come in back, it's still sticky, but it's going to come in lower. So the fear of reflation, if that comes in, the fear of reflation disappears. Okay, disappears. And if we look at the internals, market breadth is still rising. This is how many stocks are above their 50-day moving average. We have 55%. So this is a pretty much a recovery at this point, right? We're recovering here with market breadth. Market breadth is telling us that more stocks are trading higher in different sectors. It's not all big tech. Move index, right? Bond volatility. Well, insurance to buy US treasuries is down. Why? Because treasury buybacks. We talked about this last week. The US treasury is implementing buybacks. They're buying back their own treasury, their own debt. So they're going to essentially be lowering interest rates. If you get lower rates, markets go higher because they literally, everybody uses debt. Apple, Amazon, Google, Facebook, all the big tech companies 500 are in debt. They borrow money, and if their interest rates, I'm sorry, if their borrowed money, the cost at which they borrow money in the future is lower, then valuations go up, PEs expand, multiples start to expand. So bond volatility tells us there's not really risk in the bond market. And plus, the Fed is switching to QE. VIX is right back down, below 20, below 15. This is a sweet spot for the VIX. If it's below 15, the trend should be higher for stock. So I think Wednesday's the day. I think Wednesday we see all-time highs if we get that inflation in line. If we get it in line. Retail sales also, we'll see how hot the data is, but we do know employment is starting to cool down, and I think that's another indication of things slowing down. And then we're going to go over a couple of individual stocks here also. Tick add. Credit spreads are also pretty, credit spreads are good. There's just no panic. There's no panic in the market. This is corporate debt. Corporate debt is being bought up tremendously. You inverse it as this falls. That means, there's more buying power for stocks or equities than there is US Treasury. So that's risk on behavior right there. Crypto still sticking in there. Bitcoin in the consolidation area. I mean, this is just very strong price action. You can't go wrong here. Now now the real banks are actually buying this. Wells Fargo, and they don't have big, positions yet, but BlackRock, they're buying the BlackRock ETF, JP Morgan, Wells Fargo, a lot of other banks. So the wave is coming for crypto. I still believe this is this is the biggest trade for the next 12 months because, demand is up, supply is down, and you're seeing a lot of you're seeing the memes start to step in. Now we're getting meme stocks start to bid up, right? Chainlink, my favorite by far. We'll see how this plays out. What else we got here going on? So we do hear a lot. Oh yeah, that's right. Let's go to the commercial real estate stuff. This is what's on the headline right now. Here's what we got on the headlines. I think it's right here. Okay, so there's a lot of concern. I'm gonna move this over here on TikTok so you guys can see a little bit of it. So there's a lot of concern on delinquency rates. Okay. And what we're seeing here is if we just look at total debt for the market, what is the market concerned with? Total debt is rising. Okay. But it's still below 2020, still below pre-pandemic levels. That's not the concern. Total debt is not really the concern. Is it mortgages? No. Mortgages are still pretty low. That's not the concern here. Turn this a little bit. The actual concern is going to be credit card. Credit card delinquencies are up a lot. Credit card debt is up a lot. But also incomes are up. Incomes are also, incomes and wages are also driving higher. So this isn't a great way to look at, just looking at credit card debt isn't the best way to look at it, but the delinquency rate is up. So everybody points out credit card debt. It's not really that relevant unless if the incomes are also going up because people are just spending more, they're paying off their credit card. Delinquencies, this is an issue. This will probably slow us down in the summertime, right? When it comes to growth, the consumer spending, I think the consumer is already slowing down. But hey, if we slow too much, it's an election year, and they're gonna give you more stimulus. Any type of slowdown comes more stimulus. That's typically what you see in this part of the election cycle. More stimulus. Student loans aren't our issue. Student loans are not an issue here for debt. Auto loan delinquencies, those are huge, and I think this is peaking also. So we're gonna look at the actual tightening standards for loans. Let's see, credit card tightening standard. So credit card delinquencies and auto loan delinquencies, that is the red herring. That's the red flag for growth. Okay, but those are mostly the lower end consumers. Baby boomers are not, delinquent. They're still paying. They're still making a lot of money. They're not going anywhere. US, credit card tightening standards, those have peaked. right? So this is in, well, actually, let's just look at one at a time. Banks reporting stronger demand for credit cards. So people are not using more credit cards. People are not acquiring more credit. They're just not. So that risk is lower. And this is a year over year momentum signal. The momentum signal tells us there's not a whole lot of demand for credit cards. There's not. There's just a lot of delinquencies. There's a lot of credit debt out there that's not being serviced. And when we look at how much the actual standards are for, the tightening standards, which is rates going higher, they peaked. That's why we look at interest rates. They run the economy. Interest rates are going to give you a gauge on the economy and the stock market. And so when they peaked back here, that's it. We shouldn't get any more tightness. The Fed is already done tightening, which means all you need to do is service the debt. And that's going to come through monetary printing. Why? And that's why I think the Fed is reversing QT, because they need more liquidity to fuel all the debt to pay for, whether it's government. And Joe Biden's going to give out he's probably watch for stimulus. Just watch for stimulus. Who knows how it's going to come in? But expect that. Zim ready to what? ZIM? Not sure what that is. Zim? Yeah, I don't know what Zim is. Nvidia. Well, okay, cool. Nvidia. So credit card standards tightening. We're at peak tightening for credit cards. What else we got here? Auto loan tightening standards. So if we look at auto loans, have they peaked? Yes, they have. In blue is they peaked a while back. So you're not going to get more pressure for auto loans. It's just what we see now. Is there more demand for auto loans? No, there is not. No, there's not. So the worst is behind us. Anything that does surprise, the Fed cuts rates 25 basis points, and they unleash more liquidity, just like they did back in what 2020, 2023 of March. Same thing, right? So I'm not too concerned about this. Everybody thinks this is the 1980s and the 70s. It's not. It's not the 1980s and the 70s. The structure of the financial market and the economy is much different. A lot of tech jobs, supplies. There's a lot of there's not a whole lot. Unemployment is not spiking because there's a whole lot of labor supply, right? There's gig jobs, there's online, you have Amazon, I'm sorry, not Amazon. Yeah, Amazon retail, you have a lot of e-commerce that never existed in the past. Those are not going to be payrolls that you see pop up. So even with payrolls cooling down, which is good for rates, good for the market, it doesn't mean growth is going to collapse. So a lot of people, they get extreme. They go from, oh, well, we're going to have a recession. And then they go straight from recession to stagflation. Then they go from stagflation to pick one. It's either inflation is going higher. No, he didn't speak yet. He speaks tomorrow. Either inflation goes up and, growth is rising, or we're going into a recession and growth is falling apart. Which one are you going to pick? Number one. Number two, those are forward-looking things. It doesn't mean it's happening currently, or else the market wouldn't be up. And the market is much smarter than all of us, right? Let's get back to charts here. Look at a couple stocks. Okay. Yeah, so inflation rate on Wednesday, I mean, it's bullish. Inline is going to be very bullish. Somebody said Nvidia. I don't really like Nvidia, but Nvidia's still on fire. And Nvidia probably makes another big move. Probably goes to like 1100 at this point. I mean, a lot of people are waiting for the stock, not the stock buybacks, but they're waiting um for the splits, right? Everybody wants to get the share splits. I think Nvidia will do it. Who knows? They might announce that they're splitting. They're going to be split. I bet you they do it whenever they have earnings. That's a while. That's a while. That we still have 10 days. Right now, the biggest thing is going to be the inflation report for Nvidia. So no, correct me if I'm wrong, but you can't have stagflation with GDP growth. No, you can't. You can't have stagflation with GDP growth, and GDP is still pretty strong. It doesn't matter what your political view is. GDP is still up, and a lot of GDP is defense spending, and a lot of GDP is big tech spending on data centers, right? Data center growth, AI growth, but it's still there. So even if consumers are struggling, which is why I say, hey, you should be a proponent of investing, because yeah, you're not going to get good wages. Inflation is going to eat up your buying power. But when it comes to investing in stocks or crypto, even real estate, whatever it is, but stocks outperform real estate, all the value goes here. Your buying power is converted here, right? And we're seeing that in utilities. Utilities are booming simply because the data center growth is exploding. Microsoft Azure, you have Google Cloud, you have Amazon, AWS, and AWS is now $100 billion, I think it's $100 billion a year revenue grower. And so you need more data centers. So electricity, the revenue for utilities is going to go up because they're providing the electricity, right? Whether it's coming from solar, um, water, wind, it doesn't matter. They're going to convert that to the grid. So yeah, we're not looking at stagflation. That is not happening. Especially if Wednesday we get that report, lower. Shelters coming in lower. Last week GDP was at 4%. That's going to switch every week, but it still was at 4%. Taking a look at Tesla, hopefully this is the bottom. We filled the gap on Tesla. The gap was at 168. Yeah, I believe this was the gap. I wonder why it doesn't. Is this off? Something looks off here. I don't know what it is. Something looks off here. Something looks off. Either way, we'll go to that 4-hour chart. It's a little easier to see. So this was our gap up here, 168, gapped up in the morning. We closed at 168 and we already closed that. So Tesla, if it gets below 167, 168, it's probably going to take a nice dump. So again, you're in a sweet spot for Tesla. It's going to be tough. I mean, Elon Musk is juggling a lot of narratives at once. Anchored VWAP looks weak, very weak on the anchored VWAP. We'll see how he does, but either way, China, it's all about the narrative. If China is going to be, more progressive about the regulation on full self-driving, then, the expectation that Tesla pops is going to be up tremendously. Also, inflation coming down, inflation expectations will drop. And interest rates being where they're at is hurting the automotive industries. Also, autos are hurting the most, right? Credit card companies aren't really hurting that as much, but auto companies are definitely hurting the most. Still like AMD. Still like AMD. I like Robinhood too. AMD looks like it's bottoming out here. Reverse head and shoulders pattern. Can see this. Okay, here's your shoulder. Ooh, that's not what I wanted to use. Here's your shoulder right here. Shoulder, head. So yeah, I think it's Wednesday. Possibly Thursday. We'll see how that plays out. But reverse head and shoulders here, pretty good pattern to play off of. Always a strong pattern there. So once AMD takes, oh yeah, Roaring Kitty is back. Yep. That's why GME's up. I mean, it's not even the dude. It's mostly that I think interest rates are rolling over. That's going to fuel risk assets. GameStop, meme stocks, there's IPOs coming in. There's a lot of liquidity coming back in the market. And the biggest factor here is that the Fed is reversing QT, right? They are reversing QT, bull market ahead. This swing trading stuff, it may not last. Like swing trades are tough because you have to guess what stock you're trading, right? It depends, whatever you're looking at there, SMCI, like these things are tough. Okay, SMCI actually doesn't look too bad. Doesn't look too bad. There's a clear wall here of resistance. Now we got some clear resistance here. Okay, get above that resistance. That might be pretty nice. See, there's a gap up here at 930. Yeah, SMCI, but this is a very risky name. SMCI, ARM. Okay, ARM's bidding higher. All right. But either way, the market is due to go higher. I think we have a summertime rally. That's my guess. Just like Santa Claus rally last year. I think we're looking at a summertime rally. CPI, I believe, is Wednesday. Yes, CPI is Wednesday. And the expectation, the bull, if you take away anything today, listen, the bull message here, the bull market message here is that Wednesday, the market is expecting inline CPI below the previous month. If we're coming in below the previous month, then the whole reflation, inflation's coming back, stagflation, that's off the table. Stagflation is off the table. And now the risk might go back to, are we going to see defaults? I'm not worried about defaults. I'm more worried about inflation reaccelerating, not defaults, because we had the biggest default in US history from the banks in 2023, and nobody batted an eye. It didn't matter because the Fed increased liquidity. And that's what they're going to keep doing. They're going to keep debasing the currency. That is the way out of this. They debase the currency, they inject liquidity even further. And I think we're going to see that play out here. Here's your liquidity indicators. Okay. Labor force week. I got the labor force up there. It's funny because labor force is pretty much in line with liquidity. Let's go Fed. Oh, I'm going to have to restart this. Hold on. Reload tab. Save and reload. There we go. CPI numbers, we're looking at 2.8 or something like that. It depends which one you're looking at. You're asking about CPI. So when it comes to CPI, we'll look at liquidity because these are our big factors here: liquidity, inflation rates, liquidity, and interest rates. You know, the financial, I just call them economic policies. The economic policies, right, are actually very bullish right now. We're looking at the most bullish economic policies we've seen since 2020, really, right? Since 2020, that's going to move the market. Earnings are solid already. Earnings are pretty solid, and investment is back. People are trading. You see GME. Okay, yeah, this Fed balance sheet is going to start turning back up, or at least flattening out. But next 12 months, it should be up. That's going to be very positive. Fed net liquidity is what I wanted to throw out here. Why is it not popping up here? Where's our Fed net liquidity? Huh. That's weird. Well, we'll look at global liquidity then. Yeah, we'll look at global liquidity. It always pisses me off when the one thing I want to look at doesn't work. All right, comments. What up, Jervine? Global liquidity higher, crypto summer. Yep, banana zone. Yeah, we're looking at the command. We're looking at the banana zone. Study crypto summers. I actually have it up on. I do have it up there on my Twitter. We can go over that because that's. I mean, this is the biggest move of all markets. Is going to be the crypto move when it comes. The reason I say that because a lot of the AI stuff is just already factored into the biggest companies. So you're not getting gigantic moves. You're getting more secular movements, right? But anyways, yeah, global liquidity. Check out global liquidity, right? Whenever the economy, this was February 18, we peaked in liquidity there. We came down and liquidity started to make new highs in November. If you guys remember, this is when the Fed had some issues and they had to start injecting liquidity in the market. The move index spiked. Bond market had some trouble and they started coming in with liquidity. And so liquidity actually moved up. And this was when I remember these stocks were going crazy. It started to move up and make new highs. And let's make sure we mark that. Okay. These are the new highs. Started to make new highs from the low, anyways. In December 19. This was the pandemic. I mean, when the pandemic hit, yeah, they had to inject a lot, but they were already on the path to injecting liquidity, right? So we're looking at that same thing here. These are global economies. We're looking at liquidity making new lows, and it's almost done. Why? Because inflation all over the, if you look at China, if you look at Europe, inflation is falling like a rock. The US, it's a little stickier. I mean, fair enough, because the US economy is stronger than the other economies. The only other economy stronger than the US on a year-over-year basis is India and Guyana, but they're tiny. They're very small. Well, India's not tiny. Guyana is tiny, so it can move a lot. But India's up, okay? India's up also. So liquidity is, I'm telling you guys, the Fed the market is moving higher because liquidity is back. And part of that reason is the commercial real estate conditions are not good. So we're going to get something collapse. Powell even said it. Hey, we have some issues. We have some banking issues. And he's going to do the same thing he did last time, which is inject more liquidity. RRP is almost out of juice also. I wonder why this isn't loading. That really pisses me off. I probably got too many things up here. The RRP, yeah, the RRP is almost out. Once this thing goes to zero, they're going to turn it on even faster. They have to because there's no more liquidity to scoop up the U.S. Treasury debt. Oh wait, yes, there is, because the U.S. Treasury has started a program to actually do that. Right. All right. Let me go to that crypto summer thing. I know Jervine. Oh no, this isn't it. Jervine pointed it out. Crypto summer. We had a faster start as well. Yeah, crypto summer. All right. So before we get there, Jervine, check it out. Um, because you're gonna see the market gap up, I believe, tremendously if we get this right. Core inflation rate. So the month over month stuff is due to come in lower, month over month inflation. And I think we're gonna slow here. January, February, March, April should start to slow down. Nobody has a reason to spend in April. April is weak. McDonald's, Starbucks, a lot of these companies are saying, hey, the consumer at the lower end is starting to weaken. So that'll bring down consumption a little bit, right? Not tremendously, but that's going to bring down consumption. That's one factor. Number two, is the government still spending? Heck yeah. So that's not going to change. Number three, oil prices, they're tame. They're not going higher. That's good. Energy prices are not up. How about shelter and rents? Rents are coming down. This should bring us lower. And shelter is very laggy. Shelter takes 12 months because when you sign a lease, it's not like your price changes every month. It doesn't change until you refi your lease again, right? So people are looking for new homes. Those homes are dropping in certain areas. Not every area. Maybe not Miami. Maybe not Actually, San Francisco is falling. But anyways, that's core month on month. This is what the Fed's looking at, but they have their own data. They have the PCE. How about core PC? So we take out energy, we take out food. We're looking at 3.6. That's going to be a big drop here. And if you really look at the trend, boom, we're falling. It's just a slow grind. So when you see inflation is going higher, that's a lie. Inflation is sticky, is true. It is sticky, right? It's a little sticky, but inflation is not reaccelerating. Whoever's feeding that bull crap just wants headlines. That is not what's happening. It's not reaccelerating. At least the inflation rate. We're not talking about the price of your auto insurance. That's one piece of the basket. The inflation rate is falling. So if we come in line with consensus 3.6, very bullish. Markets are going back to all-time highs on Wednesday. We probably see the gap up, depending on how much we fall tomorrow. Okay. We'll see what Powell says. Listen to his tone. His tone will tell us. His confidence level is going to tell us where we're at. Now, if you add in energy and you add in food, okay, we're looking at 3.4. We're looking at 3.4, and this only tells us the PCE inflation is going to come in. If this is true, the PCE will come in even lower, getting closer to that target for the Fed, right? And we don't really have much data other than that. We have Powell speaking Sunday. But other than that, Wednesday's the big day. Tuesday, Wednesday, and Thursday, Friday, I'm guessing is where we get the big moves. So crypto summer, unless we have any comments in here. What did you say? U.S. inflation peaked and started coming down sooner or better than the rest of the world. Yeah, inflation for the U.S. came down faster than a lot of the world, but then our government spent so much, which was kind of, it wasn't like it was so negative. People think spending is so bad. It's just that it's not spending where they want it. If you owned Nvidia and the chips, you're pretty happy about the government spending. But if you own no assets, yeah, you're pissed off because you didn't benefit from it, right? Which is why it's important to understand how the system works so you can benefit from it, instead of being left behind, because they really don't care. They're not going to educate you on how to invest. It just they don't do that in schools. Um, All right, let's go. Let's switch over to the crypto summer stuff. I guess we'll just go through it raw. This thing better not freeze on me. And what are we doing here, dude? I didn't click on that. I clicked on here. Okay. All right. So global. This is GMI. This is Raoul Paul's Global Liquidity Index, and really, the basics of this is, let me see, a couple days ago, insurance and shelter was causing CPI to be sticky. Yes, insurance is really the worst thing. Insurance is service cost. Insurance is auto insurance is like 20%, but it can't just keep going because competition steps in. It already happened for me. I went to Lemonade Insurance. I was at Root Insurance because years ago, Progressive was too expensive. I went to Root, way cheaper. Root went up 5x, went to 180. Then I went to Lemonade because I don't drive much, work from home, right? Go to the gym and I do content. And so, boom, it dropped. So, competition will knock these prices down. I'm not worried about it. Shelter is sticky. It's going to fall. It's in real time, it's already falling. So that's kind of the case there. So, anyways, back to it. Crypto summer. Here's what we're looking at. Okay, spring is always recovery. When you see green, that is spring. That means liquidity is starting to come into the market because there was already recessions happening. And I believe this is total liquidity from the world. Is this world? These are all the major central banks. So this represents um, Japan, Europe, China, the biggest banks in the world. This represents the money supply that they inject into the financial system. Typically, blue is where you get where you're overheated and they need to remove it. They need to remove liquidity, things cool off, and then they have to inject it before there's a collapse, a financial collapse. They start injecting that liquidity, and yellow is going to be summer. That's typically the hottest time is summer. They're still pouring liquidity in. They're still trying to reignite growth in these different areas. You even have fiscal policies coming in, blah blah blah. Right? Red is the top. Red is typically when you're done. Now every red looks a little different. Every season rhymes. They're not perfect, but we're not even in red yet. We're barely heading into summer. So we have another 12 months of risk assets ripping higher. And the reason I focus on risk assets because this part of the cycle is where they perform the best, right? Nvidia, technology, AMD, Tesla struggling. They have a narrative issue. We'll see how that plays out. But AMD, all the EVs do, by the way. So yeah, you got chips going higher. You have AI, anything AI, Palantir exploding, blockchain tech exploding, right? So we're in that sweet spot. And here's what he says on that next slide. Oh, this is just the maturity distribution of marketable interest rate public debt. And the reason part of this is like this is very confusing. So I'm going to simplify it. He's basically saying every 1 to 5 years, every 1 to 3 years, or I'm sorry, every 3 years, the liquidity increases in order to service the debt because essentially, you know, governments, they just create more credit cards to pay off their old debt. They never really pay off the debt. But where do they get the money? They get it from the central bank buying their treasuries or buying their bonds. They issue bonds. Not everybody can afford to buy them. So the Fed steps in. That's what we're seeing today. The Fed is saying, okay, we got to step in. We got to start pumping liquidity back to buy back all these treasuries that Janet Yellen, for the US at least, is increasing in liquidity because if nobody buys them, interest rates spike, mortgages spike, everything spikes. So they need to come in and buy the treasuries to get the debt rate or to get the servicing cost down at least. The ISM is the supply chain. This is a supply chain cycle. I think it's the best economic indicator there is. Obviously, I'm copying Raul Paul to some degree. Got to copy the best to be the best, right? And this tells us, hey, when you get peak cycle, that's probably peak risk assets. Not everything peaks, but Bitcoin and crypto risk assets do peak at this point in the cycle. But we're at the bottom here, so we're starting to reaccelerate still. And I think we still got a couple more months. My guess is June, July, we start to see the reacceleration in the manufacturing cycle to positive territory, and you see crypto go bananas. So I'm going to keep saying it: summertime rally, summertime rally, summertime rally. Let's see what his next thing is. NASDAQ. Okay, so yeah, this is liquidity correlating with NASDAQ. It's pretty obvious when they increase liquidity, NASDAQ goes higher. And we all know NASDAQ outpaces the S&P because NASDAQ is basically technology, right? Apple, iPhones, it's all tech, it's all innovation, it's all, Google, whatever. All the new Instagram, WhatsApp, TikTok, those are all technology type businesses where there's new ways of producing income, through ads. So I mean, it's innovative, right? And then also here's the Bitcoin cycle. Now Bitcoin really outperforms, or crypto really starts to outperform on the up cycles of the liquidity, really outperforms on the up cycle. And we're just getting started. You see Bitcoin already got to all-time highs. This is the first time I believe that Bitcoin's ever made it to all-time highs before the halving. So that either means two things. We're going to have a short cycle, it's going to be shorter, or it means that it's going to be even more explosive. And I think I'd go with the later, the latter half. I think we're going to be actually more explosive here. simply because the demand is ridiculous. You have BlackRock. Bitcoin ETF was always a dream for crypto. The ETF is what? It is a medium to get big money in, right? The ETF, exchange traded fund, that's what the S&P is, that's what the Qs are. It's a bridge to get 401ks, hedge funds, people who don't want to do the laborious. I don't even like the process of getting your private keys. I think it's ridiculous. I don't live in another country. I'm lucky I'm in the US, so I can just get Coinbase, right? I could just use Coinbase. Well, now they can use Coinbase, they can use Robinhood, and that's what they're doing. So you have the biggest inflows in by the way, the BlackRock's ETF was the most successful ETF in the Nasdaq, New York Stock Exchange history. A lot of inflows coming in there. Now we see what JP Morgan is exposed to Bitcoin. Now Wells Fargo, they don't have a huge position, but they're trying to create a money market. They're creating a market for that. So they're going to keep accumulating more Bitcoin. Now what happened? Bitcoin's supply cuts in half. I'm telling you guys, it's not just Bitcoin, right? Because I'm bullish on Bitcoin. I think we go to 100K this year, maybe 150, but Ethereum even more so, Solana even more so. Chainlink is that's my golden goose. I think Chainlink even more so, simply because it has the best narrative, the widest use case. But we're not going over that today, right? So yeah, here's just more price action. This is the adoption rate. This is just where he talks about how why are the banks buying it? Because the adoption rate is as fast as the internet was. People are adopting this all over the world. If you live in the US, you're not too concerned because you have a pretty stable banking financial infrastructure. You have Cash App, you have Zelle, you have all this stuff, right? You have Square, but in other countries they don't. And populations in other countries are growing way faster than the US. Our birth rate is collapsing. Nigeria is exploding, India exploding, and they're all adopting crypto. So it's not just the US. This is a global asset base that is growing here, and everybody wants exposure to that. This is again the macro seasons. And what is this? Nasdaq, S&P. I think it's just it's Nasdaq. Nasdaq, same thing, right? In blue, you have the slowdowns. Why? Because that's when the Fed removes money from the system. They cool things up, they increase interest rates, or the central banks as a whole. And green is where they start to re-accelerate the cycle. Yellow is the sweet spot where we're heading in right now. That's why I say next 9 months, markets are going to go bananas unless we get a black swan, right? I'm not betting on a black swan. And then you have red, which is the top. So we're going to be monitoring. We're going to be monitoring the top. I think the top comes in mid 2025. I don't know. Who knows? Maybe March 20. Who knows? I'm going to be monitoring the top. We got a couple indicators, ISM, business cycle momentum running out. We're going to be looking at Fed liquidity. We're going to be looking at divergence in the entire market, technicals, all that stuff. So stay tuned because we're going to be looking at that throughout the cycle, so that you don't get caught on a 75, 80% drawdown unless you're just investing, right? If you trade the cycles, you're going to want to know that. If you're just investing, who cares, right? It's irrelevant. Okay, nice. So he has a peak here. Jervine, if you're watching this, you guys are watching the ISM. He extrapolates here that June 2025 should be the momentum peak of the ISM. And the ISM is simply supply chain momentum. It's growth momentum, forward-looking demand momentum for the U.S. economy, at least, right? For the U.S. economy, at least. So this is forward-looking. We'll see how that plays out. So June, somewhere around June, we don't know. We'll see. Hopefully, we get some bearish divergence at the same time. And then we got to keep track of inflation and interest rates. There's a lot of things you can look at, and it's a lot. So I'm going to do it for you. I'm going to do the work for you. That's what I do. I mean, that's how I make a living, is doing this stuff. I enjoy it. So let's keep going here. We're in the banana zone. This is what he's talking about. We're in the banana zone. We haven't even really lifted off. Now, this is definitely not a log chart, so it looks crazy. The log charts don't look as crazy. But I mean, I don't think I know some people are like, it's not going to go that high. Well, hey, we have more demand than ever in Bitcoin, right? Ever. Other countries want it. Russia, Japan. I mean, not Japan, China, Russia. Well, China's kind of negative again, but definitely the African countries. Okay, India. It's only going to get bigger eventually if we're moving to a central bank digital currency, basket of currencies across. If you believe in BRICS, they're going to use a basket of currencies. If you believe in that, or you think it's coming, well, there's going to be a basket of digital currencies. and there's going to need to be something to back it. And so Bitcoin is the only scarce asset that is a hard asset that can't be tampered with. So that's the narrative. Does it happen? Who knows? Who knows? Maybe it's just digital gold and that's the narrative. We don't know. But we do know it is technology, and technology only goes higher as they print more money. And that's what we're looking at. Um, so that's pretty much all of what Raul Paul was pointing out there, is that we're in the midst of the strongest part of the crypto cycle. Okay, strongest part of the crypto cycle. Earnings are strong for stocks. I'm trying to see if there's anything else here. Stocks are, and look, I think I put this on Friday. The debt for the US interest payments for the US each month is 100 billion. That's insane. 100 billion is bigger than most companies. So Powell's going to cut rates. He has no choice. He's going to have to cut rates. And does he cut them to zero? Hell no. But he's probably going to cut 25 basis points, maybe 50 by the end of the year, maybe two cuts. I'm guessing right now two cuts. Now, if the commercial real estate stuff really starts to pop, I believe in Texas, the biggest building got marked down from like 30 million to like 3 million. If that continues, that is deflationary. That means the property values are collapsing. So somebody's income is collapsing, and that is deflationary. So summertime rally, because things are going to be easing, rates are coming down. The dollar, I don't know what the dollar does, but my guess is the dollar falls because we increase more liquidity, we print more dollars, the value falls, assets go higher. What is this, bank credit? Oh yeah, commercial banks are actually lending more. That's on a nominal basis. But yeah, that's it right there. We'll go back to technicals. What are we at? 47 minutes. I don't want to sit too long. Hurts my back. Too many broken discs in my back. Don't play football. Don't let your kids play football. Destroy you. It's not fun. All right, let's see. Let's go back to it. So yeah. So yeah, we have that, SPY resistance is 522. I think I'm gonna give it a 70% chance. Let's go to the 30-minute chart so we can see this. Can see a little more room here. I've been trading iron condors. Look at that clear support and resistance, right? Clear ranges here, just selling calls, selling puts, and just collecting premium because I think we're getting ready for the big move. I probably won't do it on Tuesday, which is tomorrow, because I think we're gonna get a big move. I want to see, what we do, because again, if we come in line, if inflation comes in line, very bullish. I believe it too. BTC weekly chart looks ready to pop. Oh shoot. Yeah, Bitcoin looks great. Bitcoin is going to surprise everybody in my view. Now, GME, I know everybody wants to see GME, right? I don't like this stuff. I think you have to get lucky here. But there's no it's not really technical analysis. It's more of a narrative. So you might get lucky or you might not. It's up 30%. It's not earnings. It's literally some dude tweeted. This is a meme trade. So the reason I say be careful, because you're probably going to lose money. Only, a good 10% make money on these things. You got to time it correctly. And if you're not a trader, you're probably not going to be lucky. AMC up. Oh, dang, that thing's up even more. Wow. AMC's up 100. 81%. I didn't even see that. AMC even more. So AMC is pumping. If you do want to chase it, wait for a pullback and a hold of the previous level. What would be a previous level? AMC doesn't really give you too many levels. Let's go to the 5-minute. Anything on here? Okay. So for AMC, and I am not advocating this at all. As a matter of fact, I'd say stay away from it. But if I did, this is what I would do. I would look for some support here. I'm going to call it 440. Okay. Somewhere between $4 and 440, right? If you come back and hold $4, then I think it has some legs, and then you just stop out right below that, right? GME. This is a lot more clear. 28. I'm gonna say 28 here. This is a lot easier. A lot of spots, a lot of touches at 28. So you get a 28 hold, then you move higher. This thing got halted though. It probably would have went a lot higher if it didn't get halted. Got halted multiple times. AMD, I still like AMD. I still like AMD, but this is more of a longer term swing trade. Maybe you're looking out to July, right? If you're looking at July, maybe see what the daily looks like. Yeah, you're looking at July for sure on this one. But you have the reverse, you have the signal, you have the pattern forming. Um, we fill that gap at 150. You could even sell puts and buy calls. You could sell a put, like you could sell a 145 put and then buy a put below it to hedge yourself. And you're just hoping the price goes higher. Right? You make a hedge there. That's a spread. I mean, it's a little more technical. If you're not familiar with it, go find how to trade spreads. But I'm actually thinking about that, but I'm doing pretty good with the S&P right now. What else we got? Tesla, we'll see. Tesla is, I like Hood though. Robinhood, a lot of support here on Robinhood because their user base is picking up. All this AMC, GME trading is going to pump their profit margins. It's going to pump their revenues. A lot of support here at 16. Hood and Coinbase are also going to benefit from the crypto rally. Anything related to blockchain, not anything, but the main players related to blockchain, I think are easy trades into July, right? And then maybe the rest of the year, but we'll see. At least July, I think we have support here. Then we bid higher into July. Energy, if you look at I'm not a fan of energy now because oil's still a little. I don't know. I mean the whole escalation kind of slowed down, so that narrative kind of disappeared. And when I say, what was it? You have man, I can't even remember what it is. Too many things in my head. Negotiations basically between Iran and Israel, right? Now, can they go back? Can they go wrong? Sure. But right now, oil is not pricing that in. So I'm not too bullish there. Any other digital wallets? Well, Coinbase for sure. I mean, Coinbase is clearly grinding higher and clearly um is clearly showing a bull flag. Nice little bull flag here. You break above this flag. Actually, let me just draw it with this one. Yeah, that'll be nice. So I mean, yeah, Coinbase and Robinhood. I mean, it goes with the crypto cycle pretty much. So I would stick with that. Again, if you're looking at S&P, right? The story is easy. The Fed is not easy, but the Fed is reaccelerating quantitative easing. So is the US Treasury. Employment was weak. We went higher because that means higher rates, because that should be a cooling economy. We should be cooling. Therefore, inflation starts to cool. And I think we see the first head of that on Wednesday. We see inflation start to cool. I mean, PPI tomorrow should give us some more room also. Producer prices should be a little cool also. So maybe we break above that. That's why I'm a little worried about this condor. We'll see how it plays out. I think I'm at what, 416? I'm at 516 and 526. So I need the price to stay below between that going into Tuesday. I'm not trading Wednesday. Hell no. Too much volatility when that report comes out. So we'll see how that plays out. But yeah, that's all I got for you guys today. You got any questions? Throw them in there real quick. Throw them in there. Summertime rally, inflation, inflation expectations are bullish. Inflation expectations bullish for sure this time. Easy way also to kind of gauge what's happening. Just watch interest rates. Say it all the time. 10-year rates. So Wednesday could see major BTC pump. Yes. It could be. I don't want to say a major pump. I would say a major recovery. Because crypto, when it's in a bull market, it's actually less correlated with stocks, still correlated, but not as much. So maybe not, but definitely a recovery. For example, I'd say Bitcoin rallies the most when the dollar falls. So when I say rally, you should be able to see the screen. I think we go back, we get back to like 68,000. I think we're due to get back to like 68,000. Doesn't mean we break out yet. And look, the longer we build this base, the longer we consolidate, the bigger the breakout, the bigger that initial momentum push higher before we pull back again. So that could be the trigger if we come out 3-4, because then the expectation is, oh, 3-4 next month should be 3-3 or 3-2, and then 3 and then 3. Why? Because the commercial real estate is deflationary issues, right? Delinquencies deflationary. Fed cuts rates. Fed turns on QE, and it's game time. It's game time. Summertime rally. I wish I could say it in more simple terms. That's why I'm building a course so that it's not so sloppy. I'm not done yet. I know people keep asking. Trying to make it simple. This is going to be a lifelong course. Well, at least for the next, 10 years, as long as things don't change. But it's going to be education so you can think for yourself. You don't have to depend on, the news network. You can read for yourself. You can decipher things on your own, right? Fisher of men, not, because people, you want to think for yourself. You definitely want to be able to think for yourself, never get fooled. All right. Also, this is going to be important. Watch the bond market. If the bond market bids up on Wednesday, that's another good sign, right? Because if Wednesday CPI comes in line and we see bonds move up, the only thing about this is the price action gap so much it looks sloppy. Let's just turn it into a line. There we go. Employment, bonds go up. So QT taper, the Fed's tapering, bonds get bought up because they're saying, oh, you're going to buy more bonds? Cool. So are we. Employment weak. Oh, slower growth, buy more bonds. What is this? 42. Oh, US Treasury buying. Oh, no, never mind. That was the auction. We had the biggest auction in US Treasury history. They sold $42 billion. The US Treasury did, Janet Yellen. It got bought up at 4.8%. Bonds go higher. So as long as bonds go up also, this is bullish for risk assets because that means interest rates fall. Keep that in mind. As bonds go up, interest rates come down. They're literally opposite, right? They move opposite. That is significant because interest rates price the valuation of risk assets. Higher rates, worse earnings because you have to pay a higher interest rate on your debt. Everybody has debt, just like you might have credit card debt, mortgage debt, auto loan debt. Everybody has to pay their debt. So if rates go lower, then obviously the company is going to be able to generate more revenue and stocks go higher. Any other questions? Doesn't look like we have any other questions. I mean, we're in Q2. Okay, we are in Q2. We still have a full year to go, but we're almost at all-time highs. Also, if we look at in a political way, I think Joe Biden prints more money. Who does he give it to? I don't know, but I think he's going to increase that to some degree, especially if we get auto loan delinquency and we get credit card delinquencies, and then Trump's going to promise tax cuts. So the market is really set to just go higher, in my view, my opinion. This is not financial advice because everybody wants to make you more money in order to get the vote, right? In order to get the vote. It's all about inflation. But yeah, that wraps it up. I will be tomorrow. I'm not going to do Powell's. I might do some videos on what Powell says tomorrow. If it's important, I don't know if it'll be important or not. But for sure, Wednesday, we will go over CPI on Wednesday. My guess is if we come in line, right? 3-4, if we come in line, my guess is we gap up and we hit all-time highs on Wednesday. I could be wrong, but I'm going to give it a 60% chance because I see shelter rolling over, supply chain pressures coming down. Prices paid are kind of hot, so that's not great. But what else? Consumers are slowing. Consumers are slowing a little bit in April. Oil didn't move. Let's go. Summertime rally Wednesday. Let's see how things play out. All right, you guys stay blessed, get a workout, eat healthy, stay positive, keep growing, do all you can. And yeah, you guys stay blessed. Take it easy out there. Thank you.